37 banks across Europe just joined forces to build something that has nothing to do with Bitcoin, but everything to do with control. They're creating Qivalis, a digital euro that bypasses the system that currently dominates every crypto transaction on Earth, the US dollar. Right now, if you want to move money instantly across borders using blockchain, you're almost certainly using a dollar stablecoin. Tether and Circle's USDC together make up 90% of the stablecoin market. Every time someone in Berlin sends crypto to someone in Bangkok, they're probably routing it through a tokenized dollar, not because the dollar is better, but because there's no alternative with the same scale. The US didn't plan this. It just happened. And now it's a geopolitical fact. That's what Qivalis is designed to break. The consortium started 8 months ago with 12 European banks, names like BNP Paribas, ING, and UniCredit. Last week, 25 more joined. The full list now spans 15 countries, from the Netherlands to Spain to Italy. They're aiming to launch in the second half of this year with a stablecoin that's fully backed by euro reserves held in regulated bank accounts, not the offshore structures that Tether relies on. Every token will be covered one-to-one by actual euros sitting in a custodian account that European regulators can audit. The timing isn't coincidental. In July, President Trump signed the Genius Act, the first major U.S. crypto legislation, which created a federal framework for dollar-backed stablecoins. The message was clear: America sees stablecoins as a tool to extend dollar dominance into the digital economy. Meanwhile, Europe passed MiCA, the Markets in Crypto Assets regulation, which set strict rules for any stablecoin operating in the EU. That regulation became the foundation Qivalis is built on. It's not just a product. It's infrastructure designed to make the euro viable in an economy that's increasingly settling transactions on blockchains instead of through correspondent banks. Here's what changes if it works. A company in Germany that wants to pay a supplier in Vietnam could hold euros digitally, move them on a blockchain, and settle the transaction in minutes, without converting to dollars at any point. A developer in Poland could build a decentralized app that uses euro-denominated smart contracts instead of defaulting to USDC. The dollar would still dominate. But it wouldn't be the only option that actually functions at scale. The European Central Bank has been skeptical. Christine Lagarde said in May that she wasn't convinced Europe needs private stablecoins when the ECB is already working on a digital euro. But that's the tension. A central bank digital currency gives governments direct visibility into every transaction. A stablecoin like Qivalis, issued by a consortium of regulated banks, operates more like traditional money, private, but supervised. It's digital cash, not a government ledger. The real test is adoption. Tether has network effects that took a decade to build. Every exchange lists it. Every trader knows it. Qivalis will launch with regulatory credibility and bank backing, but almost no one using it. Whether 37 European banks can bootstrap a parallel financial system, or whether the dollar stablecoin duopoly is already too entrenched, will determine if this is the beginning of a multi-currency blockchain economy, or just another experiment that fades because no one outside the consortium actually needs it. One number to watch: how fast Qivalis reaches 10 billion euros in circulation. Tether took years. Circle took less. If Qivalis does it in months, it means European institutions are ready to route real capital through a system that doesn't touch New York. If it stalls, it means the infrastructure is there, but the demand isn't, and the dollar's dominance in digital finance will have survived its first serious institutional challenge.